My name is Rajeev Gupta. I'm one of the founders and partners at Alium Capital. What I want to do today is talk about several issues that are at front and center of everyone's mind when we think about investing, how we support them, some of the companies that we're seeing today and how we should respond to them. I also want to share some data points on what some of our companies are doing in this COVID-19 environment and how they're preparing for the recovery. Given that we have around 50 private companies, there's several elements that we have learned during this recent 6 to 8 week period. And I want to share some of the investor tips which may be useful to you. And then I want to wrap up with what some of our best founders look like and what a successful potential investment criteria might be when we recover out of COVID-19. In terms of a general overview, who are we? Alium Capital is not a venture capital firm, nor is it a strict private equity firm. We sit somewhere in between, and we're a $300 million crossover investment fund. So we invest in both public and private assets. Our ultimate goal is to invest in private assets that can list on the Australian Stock Exchange at some point. We've had recent success with Atomo Diagnostics, which listed only 2 weeks ago in this COVID-19 experience. We also had last year Aerometrics, Damstra and Nitro, all multi-$100 million companies plus that listed on the stock exchange. Our thesis is technology on the ASX is still only around 10% of the total index. If you look in the US, that number is in excess of 50%. In this COVID-19 world and this world of work from home, technology will become a more important part of our lives. And we feel that more companies listing on the ASX provides a great opportunity for retail and institutional investors to provide capital and grow with them over time. We do also in the public equity space focus on some placements, blocks, recapitalizations, and that is to become more familiar with the public markets and to find great value at great prices and then to generate a return. As a fund, we are constantly focused on liquidity. That is an important part, which is why we invest in private to get that liquidity coming when they become public assets. To give you a bit of a subset of the Alium portfolio, here on the right-hand side, I've got some assets that we are invested in. There's a breadth of enterprise SaaS, insurance, food tech, marketplaces, and some of the brands that you may have heard of, the likes of Koala, Academy XI, which is online education, Nitro, which listed last year, which is a document management productivity company, and Atomo I mentioned recently, which is a rapid diagnostic testing company, which did very well when it listed. So what is our focus today? Alium has always been and will continue to be a business focused on investing in technology, whether that is for enterprise technology or whether it is in the consumer technology space. That is where we play. Most of our businesses have been in existence for greater than 3 years. And when we invest in them, they are already at a point where they have traction and they're validated. That's reflected in almost 50% of our portfolio holding profitable companies. And some of these companies are very profitable. And in identifying these assets, what we're looking for is the execution traction they have, the product that they've built, the teams that they've assembled. And then we try and negotiate very respectfully of arriving at an investment in those companies at the right price. So we are a valuation sensitive investor. In the last couple of weeks, I'd say since the end of the first week of March, we've spoken to all of our companies. We speak to them multiple times during the week. And we've been helping them with financial austerity and planning. Several of them need help with funding, what they should be doing. And part of that is initially to cut cost and then plan to get the highest return on what you have in terms of cash and staff. We've also been helping them with some strategies around staff whereby you are cutting salaries. JobKeeper has been beneficial, but coming up with a plan around ESOP to compensate for maybe some lost value that some of the staff members have. We are still speaking with businesses that are new, that are wanting to raise capital. Just this week alone, we've had 9 Zoom calls with new companies that are trying to raise capital. So whilst people may think it's impossible, companies won't want to, there's always a great opportunity to be meeting new businesses, learning about them, and then ideally investing in them. Logically, you will think that most people want healthcare in this environment or productivity, and no one will want to touch travel or hospitality related businesses, because that's what we see as being, not we as a fund, but we as a community see as being problematic, but maybe that is where the opportunity is. So always be open-minded, which is what we are. In terms of how we've helped our companies, and to elaborate on it a little bit more, 15 of our companies, in fact, had record revenue in the last 6 weeks because there is an online bias and the market's gravitated towards them. We are very forthright and open to making sure that we talk to our companies. We're visible with them. We're talking to the founders, we're talking to the board, we're talking to staff if they want to speak to someone that's non-internal but also has a vested interest in the business. And we tell all of our founders and CEOs, focus on 2 things. Focus on your staff first. Make sure they're looked after, make sure they're remunerated, make sure they're being productive. And then importantly, look after your customers. There's an element of customer service that must take place to ensure that your customers that use your product or service can continue to use it in this environment. We have found that many of our companies have successfully cut cost, and JobKeeper was an important part of the catalyst there. So whilst for some businesses demand has weakened, they have generally cut costs by an equivalent amount. Therefore, they're negating the negative impact to their business. And that leads to them wanting to be financially sound. Everyone wants to get through this. We all will as a community. And we need to ensure that the businesses plan to come back stronger and leaner out of COVID-19. In terms of new investment opportunities, we're always looking to deploy capital and assist companies and founders. We are supporting some of our existing portfolio companies. I would say from a context standpoint, in the last 1 year, we have been less active than previously. We've only added 3 new companies to our some 50 portfolio of companies that we have. That's because we thought valuations have been far too stretched and some of the businesses were just far too novel, for want of a better way of putting it. I do believe within the next 6 months, we will see some very attractively priced companies and deals. And a lot of those were probably very expensive last year. And just a subset of that, one of the companies that we held a call with this week, they were trying to raise money at a valuation close to $75 million in the industrial enterprise SaaS space recently. And then when we spoke to them, the valuation had come down by 50%. Business had not, but they were concerned that there would not be any capital providers, and they took the front foot approach and did cut their valuation, which looked expensive when they came the first time around, but was looking a lot more attractive now. So we're doing some due diligence on that. I do strongly feel that coming out of COVID-19, this whole growth that we have been used to for the last couple of years will change to profitable growth. I'd rather see companies grow at a lower pace, but it must be much more profitable and a very clear path towards that. Some of the themes, as Warren Buffett says, you should always buy good assets at good prices, and he's always greedy when others are fearful, as we know. I do feel that healthcare innovation will be an important part of new companies trying to raise capital with new business models in the next 12 to 24 months. Smart manufacturing, which Amazon deploys and employs, will become important as well. And then obviously remote workforce productivity, collaboration is a significant theme. Telecommunication companies have come to the fore, platforms that are built on it that win, such as Zoom. I do think VR and AR, which has been talked about for many years, may also end up being much more important on a 12 to 24 month view as well. So those are some of the key segments that will tap productivity, less human touch, and enhance efficiency. Some best practices that we deploy, as I said earlier, stay in touch with your investments. We talk to them frequently. We've set up WhatsApp and Slack channels with most of our founders, CEOs, boards, and management companies. Be there to listen and assist whenever you can. We've made introductions to our accountant. There are bankers that we've introduced some of our companies to as well that need advice around M&A or raising capital. And if you're in touch with people that are in the political space or people that have domain experience in certain verticals or at big companies, facilitate a dialogue. You know, we recently set up a call between a company that we have in enterprise SaaS in Melbourne with an individual at a very large multi-billion-dollar US software company that we know who runs their Asian product. And we hooked both of them up to have a conversation and ended up being quite fruitful. So introducing those thought leaders is very useful to your companies. Be proactive. Investment criteria. This has been something that we've always focused on. I think it's amplified now. Path to profit I've mentioned. Sustainable margins. Just growth is great, but margins are what we invest in to get a return. We focus on asset light, human light businesses. We do spend a lot of time understanding technical capability of the team to ensure that they can build a product, and then you have great people in marketing and sales that can sell it and generate revenue. Low cost is a criteria that I think becomes more important out of this. You don't want to underpay your staff, but you must be aligned with them, whereby don't pay just in cash, get alignment with stock and ESOP. And for a business like ours that focuses and hopes that companies will become public assets, that ends up being a driver of finding great people who believe in the journey, believe in the story, and will be remunerated on a medium to longer term basis. Founder Glint, this is something that is critical for us in all of our investment decisions. That one person or two founders or single CEO that lead a business, they can't just have a single skill. They must understand finance, sales, product and technical, and also understand raising money with stakeholders. That capital management part is key. Some of our best founders are extremely transparent. They tell you the good and the bad. We found in the past when we're doing DD on some companies, some founders are just not so transparent, which is not so great. Articulating vision is something that, you know, our investors expect for us to be supporting. Businesses such as Koala, which is one of our larger portfolio assets in e-commerce, you know, their management team is able to articulate what they want, how they're going to do it, and what they'll build as a march towards being $1 billion asset. Ability to inspire and hire people is important. And then that single founder or the founders of the team at the top, they must want to win and they must institute change, because that's how they dominate. With that in mind, I again thank Wholesale Investor and CRIISP. Thank you so much.